they're two different things. The global economy is the big topic. That's what we all care about most. But financial markets can come up with their own narratives and go their own way, at least for a while. So you have to, they're not in sync. They will be in sync eventually, but not always right away. A lot of times the financial markets get ahead of themselves and then they wake up to reality and they, oh, crash, correct down. In terms of global economy, I think your use of the word global is very much on point, because it's often the case that, you look around the world, you've got the United States, or, North America, if you want to throw in Canada, you've got the EU, you've got China, you've got Japan, they're all important economies, but they can kind of be in different parts of the business cycle. And it's not unusual for one part to be in recession, but another part of the world is like doing better. So that they use the phrase locomotive theory. The locomotive is going to pull us all out of the ditch, and we'll get going. So it's not unusual to have recessions in the United States or Europe, or particular countries in Europe or Japan. I mean, Japan's had 9 recessions since 1989. I mean, 9. I consider that one long 30-year depression. That's a debate for another day, but that's how I would describe Japan. But it usually, one's not doing so well, another part of the world's doing better. That's not the case. What is happening right now, I see it, but there's an awful lot of data to back it up, is that we are going into, or may already be in, a global recession. 1929, everyone's like, yeah, October, I think 18th or 19th, it was late October 1929, the stock market fell 22% in 2 days. It wasn't one day, it was like 12% one day, 11% the next day, so 23% over 2 days. But that wasn't the crash. I mean, that was the beginning of the crash. This Dow Jones fell 82%. From top to bottom. Now, it took 3 years. It bottomed in June 1932. Started in October 1929, so not quite 3 years. But that fell 82%, and that happened. So yeah, we're down. Nasdaq's down. Bounced back a little bit in recent days. Down close to 30%. Down, the S&P down over 20%. We're in bear market territory, but that's just the beginning. That's not what a full bear market, full market adjustment looks like in the face of the kind of recession that I expect. Now that's rare. It's rare when China, Japan, US, Germany, they're all in recession at the same time. But that's what's unfolding. That's a big deal. Well, for obvious reasons, because it affects basically everyone. But there's no life preserver. There's no, it's not like China's going to pull us all out of it with cheap exports, or Japan's going to put the pedal to the metal in terms of fixed asset investment, etc. So that's a really bad sign. I mean, and just to be very specific, we just saw U.S. fourth quarter GDP grew at a 2.9% annualized rate. People are like, yeah, that's pretty good, and it's not good by post-1980 standards. It's not good at all by post-World War II standards, but post-2008, yeah, that's not bad. So we haven't really seen the market collapse, stock market collapse that I would expect in association with a severe recession has not happened yet. This is just going to play out. It'll get worse as the year goes on.
All right, so you're expecting a major correction in stock markets.
I mean, that is my expectation. I have my own models and I look at it closely, but if you listen to Michael Burry, Jeremy Grantham, Charlie Munger, these people have been around, and they run, hundreds of billions, and they're saying the same thing. So Jeremy Grantham actually did do a 100-year time series and looked at bubbles all over the world, 1929 US, 1989 Japan, 2000 dot-com stocks, and many others. And he said he's never seen anything like it. It's a triple, greatest bubble of all time, times 3, in the sense that it's real estate, stocks, and other asset classes. So yeah, I do. That is my view, but it's shared by a number of other analysts. So the global economy is in bad shape. It's going into a recession. Now, a lot of people have said that. We're going to have a recession as if it's no big deal, but they're expecting a mild recession. I see a much more severe recession based on a lot of factors, some of which we've spoken about. Now, the other half of your question, which is important to listeners, is what does this mean for financial markets? And there, the best way I've been able to explain it: imagine you're in an Irish pub, and you got three Irish storytellers, and I'm part Irish, so I can talk about the Irish, but they're telling three different stories, and you got to listen to each one. So there's the Fed story, the market story, and then there's something called reality, what's actually happening. So the Fed story kind of goes like this. The Fed, forecasting what the Fed's going to do is the easiest thing I do. It's not because I have a crystal ball or I'm smarter than anyone else. The Fed actually tells you. All you have to do is listen and believe them. Now, a lot of people don't listen, or they listen like, oh, the Fed will never do that. They will. They actually mean it. We did see this in the 1930s, well, between 1929 and 1933, during the first phase of the Great Depression. It was the Hoover administration. Then Franklin Roosevelt came in 1933, and Roosevelt faced exactly the same problem. I mean, he shut every bank in America on like his second or third day in office. By executive order, he closed every bank in America. Can you imagine President of the United States today? I don't care if it's Biden or Trump or anybody else, Democrat or Republican, issuing an order saying every bank is closed as of now. We'll get back to you when they're going to reopen. And that's what FDR did to break the banking panic. But he still had the deflation problem, and the Fed couldn't do anything. I talked to Ben Bernanke about this personally, because Bernanke wrote a book on this, and I read the book, and I said, Mr. Chairman, I said, here's what I think you said. Did I get this right? He said, yeah, that's it. You understand it correctly. And Jay Powell is probably sick. He's given 6 speeches either. He keeps saying the same thing. He says, inflation is job one, period. We're not really worried about anything other than inflation, and we're not going to rest until we get it down to 2%. And he said, we're going to have a recession. He didn't use the R word, but you don't need a decoder ring to figure that out. He said unemployment is going to go up. And the Jackson Hole speech, he used the word pain like 5 times in one paragraph. I've been doing this for 45 years. I've never heard a Fed chairman use the word pain. He said, there's going to be a lot of pain. You're going to feel the pain. But the point is, he meant it. And they've been going down that path. So what are they trying to do? They're trying to get to something called the target rate. And you say, hey, Jim, what's the target rate? Well, I don't know what the number is, but neither does Jay Powell. Nobody knows what the number is. But the theory is the target rate is the rate at which rates are high enough that inflation comes down on its own without further rate hikes.